Right now, the IRS is sitting on billions of dollars that belongs to ordinary Americans, not wealthy Americans, not corporations, ordinary working people, retirees, and families who earned this money, qualify for it completely, and will never see a single dollar of it. Not because they did anything wrong, but because nobody told them the rule existed. The amount can be as high as $6,400 per year. And it is not a loophole. It is not a trick. It is a credit written directly into the United States tax code that Congress created specifically for working Americans and families. It has been there for decades, and the IRS will not call you to tell you about it. They will not send you a letter. They will not remind you at tax time. They will simply process your return exactly as you filed it, and keep the money you left on the table. I am going to tell you exactly what this credit is, exactly who qualifies, and exactly how to claim every dollar you are owed before the deadline passes. Stay with me through this entire video because the qualification rules have details that most people get wrong, and getting them wrong means leaving thousands of dollars with the government that belongs in your pocket. My name is Dr. Diane Marshall. I spent over 2 decades working inside the federal legal system. What I am about to share with you is completely legal, completely legitimate, and used by millions of Americans every single year. The problem is that millions more who qualify never claim it at all. After this video, you will not be one of them. Before we go any further, subscribe right now and turn on notifications. Every week on this channel, I bring you the rules, the rights, and the information that affects your money and your life. In plain English, no jargon, no agenda. Hit that subscribe button now. The credit I am talking about is called the Earned Income Tax Credit. You may have heard the name before, but I want you to stay with me because what most people think they know about this credit is incomplete. And that incomplete knowledge is exactly why so many people who qualify never claim it. The Earned Income Tax Credit, the EITC, is a refundable federal tax credit for people who work and earn income below a certain threshold. Refundable means this is not just a deduction that reduces what you owe. This is actual money the government sends back to you. Even if you owe zero in taxes, even if you already got a refund. If you qualify for the EITC and did not claim it, the IRS owes you money right now. The maximum credit for the current tax year reaches up to $6,428 for families with 3 or more qualifying children. For families with 2 children, the maximum is over $5,700. For families with 1 child, it reaches nearly $4,000. And even for workers with no children at all, the credit can reach over $600. These are not small amounts. For millions of American families, this credit is the single largest financial transaction of their entire year. And the IRS estimates that 1 in 5 eligible Americans does not claim it. That is approximately 20% of the people who qualify walking away from money that is legally theirs. Now let me tell you who qualifies, because this is where most people make their first mistake. They hear Earned Income Tax Credit, and they assume it is only for people in poverty. It is not. The income limits are higher than most people realize. For the current tax year, if you are married filing jointly with 3 or more children, you can earn up to approximately $60,000 and still qualify. If you are a single filer with 2 children, you can earn up to around $53,000 and still qualify. If you are single with no children, you can earn up to around $18,000 and still qualify. $60,000. That is not poverty. That is a working, middle-class American family that is leaving up to $6,400 with the IRS every single year simply because they assumed they did not qualify. But the income limits are only the beginning. There are several other qualification rules that trip people up, and I am going to walk through every single one. Rule number 1. You must have earned income. Earned income means wages, salaries, tips, and net self-employment income. It does not include Social Security benefits, pension payments, unemployment compensation, or investment income. You must have actually worked and earned money during the tax year to qualify. Retirement income alone does not qualify. Investment dividends alone do not qualify. You need earned income from actual work. Rule number 2. Your investment income must be below a certain limit. For the current year, if your total investment income, interest, dividends, capital gains, exceeds $11,000, you do not qualify for the EITC, regardless of your earned income. This rule exists to prevent wealthy investors from claiming a credit designed for working people. But for most working Americans, this limit is not an issue. Rule number 3. You must have a valid Social Security number. You, your spouse if filing jointly, and any qualifying children must all have valid Social Security numbers issued before the due date of your return. Individual Taxpayer Identification Numbers, ITINs, do not qualify for the EITC. This is a hard rule with no exceptions. Rule number 4. Your filing status matters. You can claim the EITC if you file as single, married filing jointly, head of household, or qualifying widow or widower. You cannot claim the EITC if you file as married filing separately. This is a rule that catches a surprising number of people. If you and your spouse file separate returns, neither of you can claim this credit, even if you would otherwise qualify in every other way. Rule number 5. The qualifying child rules are specific. If you are claiming the EITC with a child, that child must meet 4 tests. The relationship test. The child must be your son, daughter, stepchild, foster child, sibling, or a descendant of any of these. The age test. The child must be under 19 at the end of the year, or under 24 if a full-time student, or any age if permanently disabled. The residency test. The child must have lived with you in the United States for more than half the tax year. And the joint return test. The child cannot file a joint return with a spouse unless they are only filing to claim a refund. These rules seem complicated, but they describe the vast majority of American families with children. If you have kids living with you and you are working, there is a very high probability you qualify. Now let me talk about the people who are most commonly missing this credit, because this is the part of the video that I want you to share with someone. Group 1. Self-employed Americans. If you work for yourself, freelancers, gig workers, contractors, small business owners, you absolutely can qualify for the EITC on your net self-employment income. But many self-employed people make 2 critical mistakes. First mistake. They do not realize self-employment income counts as earned income for EITC purposes. They assume the credit is only for people with traditional W-2 jobs. It is not. Second mistake. They write off so many business expenses that their net self-employment income drops below the minimum required to qualify. If your net self-employment income after expenses is very low or zero, you may not have enough earned income to generate a meaningful credit. This does not mean you should avoid legitimate deductions. It means you need to understand how your deductions interact with your EITC eligibility. Group 2. People who had a major life change. Got married this year, got divorced, had a child, lost a spouse, changed jobs, moved. Any of these changes can affect your EITC eligibility in ways your previous tax experience did not prepare you for. Someone who did not qualify last year because their income was too high may qualify this year after a job change. Someone who got divorced and now files as head of household may qualify for the first time. Life changes mean EITC eligibility changes, and most people do not think to check. Group 3. Grandparents and other relatives raising children. If you are a grandparent, aunt, uncle, or older sibling who is raising a child, that child may qualify as your qualifying child for EITC purposes, even if you are not the biological parent. Millions of Americans in this situation never claim the credit because they assume it only applies to parents. It does not. If the child lives with you for more than half the year and meets the other qualifying tests, you may be eligible. Group 4. People who simply did not know the income limits. This is the largest group by far. People earning $30,000, $40,000, $50,000 who never checked because they assumed they made too much. The income limits are significantly higher than most people realize. If you have never specifically looked up whether you qualify, you may be leaving thousands of dollars unclaimed every single year. Now let me tell you about Margaret. Margaret is 62 years old and lives in Tennessee. She works part-time as a school cafeteria worker, earning about $22,000 a year. Her adult daughter moved back home 2 years ago with 2 young grandchildren after a difficult divorce. Margaret became the primary caregiver for both grandchildren while her daughter worked night shifts. Margaret filed her taxes every year using a basic online tax program. She filed as head of household. She entered her income. She claimed both grandchildren as dependents. The program calculated her refund, but the program never clearly explained that she qualified for the Earned Income Tax Credit. And Margaret never thought to ask because she assumed the credit was for younger parents in lower income brackets. She was 62. She earned $22,000. She did not think of herself as someone who qualified. For 2 years, Margaret left over $4,000 per year on the table. $8,000 total. Money she had earned the right to claim. Money that sat with the IRS because nobody told her the rules. When her nephew, a tax preparer, reviewed her prior returns, he caught it immediately. They filed amended returns for both years. Margaret received a check for over $8,000. Margaret's story is not unusual. It is playing out in homes across America right now. The difference between Margaret before her nephew reviewed her return and Margaret after is the same difference I am trying to give you right now. Knowledge. Before the deadline passes. Now here is something critically important that most coverage of the EITC completely misses. You can claim the EITC for prior years that you missed. If you did not claim the Earned Income Tax Credit in a previous year and you were eligible, you can file an amended tax return to claim it. The IRS allows you to go back 3 years to claim a refund you missed. That means if you qualified for the EITC in the last 3 tax years and did not claim it, you could potentially receive multiple years of credit in a single amended filing. 3 years of unclaimed EITC at even a modest credit amount adds up to a significant sum. For families with children who qualified for the maximum credit, 3 years of unclaimed EITC could represent over $15,000 in refunds that are still legally available to claim right now. The amended return form is IRS Form 1040-X. You have 3 years from the original filing deadline to submit it. Do not wait. Here is your action plan. 5 steps. Do these before the next tax deadline. Step 1. Check your eligibility right now using the IRS EITC Assistant. Go to irs.gov and search for EITC Assistant. It is a free tool on the IRS website that walks you through a series of simple questions and tells you definitively whether you qualify and approximately how much you can claim. It takes about 10 minutes. Do this today. Step 2. Pull your last 3 tax returns. Look at each return and check whether the Earned Income Tax Credit appears on line 27 of your Form 1040. If it does not appear and you earned income during those years, there is a real possibility you left money on the table. Compare your income, filing status, and family situation from each year against the eligibility rules I just walked you through. Step 3. If you find a missed year, file Form 1040-X immediately. Do not delay. You have a 3-year window, and that window closes on the original filing deadline of the return you are amending. If you are amending a return from 3 years ago, your window may be closing within months. Act now. Step 4. If your situation is complicated, use a qualified tax preparer. Self-employment income, major life changes, multiple qualifying children, or split custody situations all add complexity to EITC claims. A qualified tax preparer who is familiar with the EITC can identify credits and situations that basic tax software frequently misses. The cost of 1 hour with a good tax preparer is almost always less than the credit they help you find. Step 5. Share this information with one person in your life who works and earns a modest income. The people most likely to be missing this credit are the people least likely to stumble across information about it on their own. A working parent, a grandparent raising grandchildren, a part-time worker, a gig worker, a recently divorced person filing on their own for the first time. One conversation could put thousands of dollars back in their pocket. Before I close, let me bust 3 myths about the Earned Income Tax Credit that are keeping money out of American pockets right now. Myth 1. I make too much to qualify. Check the actual numbers before you assume this. A married couple with 3 children can earn close to $60,000 and still qualify. If you have never specifically verified your eligibility based on current year income limits, do not assume. Check. Myth 2. I already get a refund, so I do not need to worry about this. The EITC is a refundable credit. That means it is added on top of any refund you already receive. If you qualify for a $4,000 EITC and you are already getting a $500 refund, your actual refund should be $4,500. Getting a refund does not mean you already claimed everything you are owed. Myth 3. The IRS will catch it and fix it for me. The IRS will not proactively identify that you missed the EITC and send you money. They process the return as filed. If you did not claim it, they will not claim it for you. The responsibility to claim every credit you qualify for belongs entirely to you. The IRS will not reach out and say you left money on the table. Let me bring it all together. The Earned Income Tax Credit is real money, up to $6,400, that the federal government owes to working Americans and families who qualify. 1 in 5 eligible Americans does not claim it. The income limits are higher than most people realize. Self-employed workers qualify. Grandparents raising grandchildren qualify. People who have experienced major life changes may qualify for the first time this year. You can go back 3 years to claim credits you missed. The IRS EITC assistant at irs.gov takes 10 minutes and tells you exactly what you qualify for. And the only thing standing between millions of Americans and thousands of dollars in refunds is not eligibility. It is awareness. Now, you are aware. If this video gave you something valuable, hit the like button right now and share it with one person in your life who works hard and might be leaving this money on the table. That share could put thousands of dollars back in the hands of someone who earned it. Subscribe to Alert America because this is what we do here. Every single week, in plain English, no jargon, no agenda. Just the truth about the rules that affect your money and your life. Stay protected. I will see you in the next one.